Also with us, Michael Aronstein, Chief Investment Strategist at Oscar Gruss Son. Michael, I want to start with you. And you take obviously a longer term look at the markets, not necessarily what's going on minute to minute here, but you are, I talked to you this morning, more bullish than most of the people I've spoken to on the equity markets, especially because you think it's good not just for the next 6 months, but for the long term here. Why?
Well, I have somewhat the same view I had a year ago, which is that people are underestimating the resiliency of this economy. And I think at this point, that's not as controversial a position. But I think what people are missing is the earnings potential out of the corporate sector in the United States. I think earnings are going to be much higher this year than consensus estimates.
Which is about $78, $79.
Yeah, I think those could be 20% too low.
What about all the headwinds that people often come on this show armed with? You've got, obviously, sovereign debt problems. You've got, I mean, really, you could really package these. You've got the interest rate concerns. You've got the unemployment concerns. They make sense. I don't want to belittle them, right? They make sense, but you sort of shrug them off.
Well, you can't invest by reading the newspapers. You really have to have a point of view that's atypical and something that's not an accepted factor. The market's pretty efficient in incorporating these factors that are popular and that have really been sort of played through the press. And so if you're going to have results that are unusual, you have to take a perspective that's somewhat apart from what the consensus about the market is.
So, Michael, essentially you're arguing that these may be negative events, but they're expected negative events and therefore have already been factored in? Yeah,
the stock market, values arise in the stock market both too low and too high because of misperceptions, not because of common wisdom. It's when the common wisdom is wrong that you get a discrepancy between the actual path of the market and the current value. And no, I spend my whole day talking to both institutional and individual investors, and I can't tell you how many times I hear the same arguments as though everybody's just come from the same billion-person meeting and they've been handed a script. And it's very, very telling. Certainly, the stock market right now is not as glaringly misvalued as it was 12 months ago. But that said, a lot of the people who are really negative about the stock market and are rolling out all these, what I would consider to be well-known negatives, were just as negative 12 months ago.
What if you take the really long-term view, though? I mean, you and I have been talking about for years the problems with deficit spending here in the U.S. And we talked this morning about the fact that sovereign debt is an issue, but it looks the same or worse over here. I mean, is that a concern for you at all?
Sure, all of these things are concerns, but they're only concerns in a practical sense when the market is ready to reflect the actual mechanism. Over-indebtedness is a big issue, but it comes to the fore at the point where you're either threatened with default or, in the case of some sovereignties, much higher interest rates. Before that, it's kind of common knowledge in the same way that the housing excess was well recognized and written about by people in 2003. I saved some of the papers. For 4 years, the housing stocks did nothing but go straight up, and I know a lot of people who covered their shorts in 2005 and 2006 right at the highs because they had been out of sync with the marketplace.
So let me ask you what you think about this, because the drop in volume has been a trend that we've seen since, I think, March of 2008, really come down from the peak there. A lot of people would say it's a new normal in the way investors deal with equities. Maybe people were once bitten, twice shy. Baby boomers don't want to come back. It's different this time. What do you think?
I think a lot of it has to do with market structure. We're in a world where most orders now are executed algorithmically. People just, they put the ticket in the machine, and through the day, the machine responds to the market volume and the movements. And it's not like the old days where institutions would put up big prints of hundreds of thousands or millions of shares in a stock, and they'd be trading with the upstairs. And I think that's really, from a day-to-day standpoint, limited the overall liquidity and limited people's willingness to go in and create the volume. I think the market now responds sort of to the offered side in a bull market, and there's just not been that much stock offered. So I think the institutions will take more and more time to get executed. Now, this is just a surmise of mine. I have no real basis for backing this up, but on the low volume aspect, volume marks the beginning and end of trends. In between, you generally get low to moderate volume, and I wouldn't like to see an explosion in volume here. It would
not like the traders down the Chicago Mercantile Exchange.
No,
who need it, obviously.
Yeah, I agree. I think there's an underlying bid in the marketplace that is manifest every time the market comes in. There's money being committed to it, and I think the asset class globally that people are the most undercommitted to relative to norms is traditional U.S. equities, particularly those that are tied to the business cycle. People are happy to put money almost anywhere else in emerging markets and foreign stocks and commodities and bond funds and alternative investments, but plain old U.S. stocks that used to form the core of people's portfolios are still not a beloved sector by any means. So I think that's going to be corrected going forward if we're correct about the economy.
What do you think we're going to see for corporate profits? You're so bullish on corporate earnings. Where are we going to go? I mean, $88, $90?
I think you'll be north of $90.
And we continue on that kind of growth path going forward in the next couple of years?
I'm not certain. No, it's hard to look out past 12 months because there are a lot of twists and turns in the road. But I think the market's appraisal of the potential over the next 12 months, I think, is far enough off to create some continued opportunity, particularly in companies with earnings leverage.
What about Washington's ability to throw a wrench in the works? I mean, $1 billion is just a one-time charge, as Zara mentioned, but it's a big one-time charge. I mean,
well, they're trying their best. They really are. It's not that unusual to have bull markets in the face of lousy governance, which is what we've got going on now. At some point, it will matter, and it will matter in a big way. And people may look back and say, well, how could we have let this happen? But that's just the way markets work, is things are out there that are going to be consequential at some point. But it's the point of effect that, as a money manager, you have to really be cognizant of.
Hey, Richard, we'll switch gears a little bit and talk to you about home builders. I almost forgot because I did tease it, and we talked about it this morning. You like home builders a lot, and you say even though their earnings are going to be, or even though, their earnings will break even though their production levels are going to be at depressed levels, or remain at depressed levels, lower than Japan even. Yeah,
it's almost a microcosm of the whole corporate picture. I mean, we right now are constructing fewer new homes than Japan, which is, I think, absurd. But for the most part, the big public home builders are still going to have positive cash flows this year, and some of them are going to have positive earnings, even at these levels. If we go to simply from a disastrous to a depressed level, I think the earnings power of these companies is really going to surprise people. You're consolidating this industry. You're not going to have as many sort of mom and pop home building shops as you did during the last cycle.
What about the concern that foreclosures are going to flood the market here? We had 3 million last year. We could have almost 5 million this year. And a lot of concern that plans out of Washington to stem foreclosures aren't working.
Well, foreclosures don't eliminate the demand for housing. You don't get rid of the family. The demand stays where it is. And for the most part, if you look at the details of where the foreclosures are taking place, it's not in areas that readily compete with new home construction. And I think it's another aspect of this whole secular decline in the excesses in home building that the market and market participants are already aware of. It's not a news item anymore.
Michael, even 20 minutes is not enough time with you. We need to have an hour-long special. Michael Aronstein joining us from Oscar Gruss Son Inc.